Good evening to all of you. Welcome to our class. See, last time we met, we were discussing on how to manage or how to determine the company working capital need in the future, in the next 6 months, in the next 1 year. Okay, that's what we were discussing the last time we met. So today I want us to discuss on what's referred to as the working capital investment policy. Working capital investment policy. Now, there are 3 policies that a company can follow when it comes to the management of working capital. When it comes to the investment of the working capital, one is called the conservative working capital investment policy. Then you have another called the aggressive working capital investment policy, and you have what called a moderate investment working capital policy. So those are the 3 policies that a company can follow when it comes to working capital management. What's the distinction between those 3 policies? The distinction is more towards the element of risk. Okay, it's more towards the element of risk. Now, if if a company has more of manager who are in quote risk averse, okay, they are not aggressive, they are not risk takers, then essentially the company will be following what we refer to as conservative working capital investment policy. So it's all about the risk. Okay, how are the managers of this firm? Okay, are they risk takers? In the case of the conservative working capital policy, the company, the managers will be the one who are more of their risk-averse managers. Okay, so they'll be avoiding cases where there could be risk they do expose the company to. If, for example, it's about the customer, okay, the company will try as much as possible not to be in bad relationship between the firm and the customer. So what do? They'll be offering their customer better credit terms compared to the competitors. Okay, when it comes to the cash, what do? They're going to be having more cash than necessary. Okay, or cash way above what they need, because they want to avoid chances of having the insolvency risk. Okay, cases where the company may not be able to pay for the obligations as and when they fall due. So they'll be trying as much as possible to have more cash than what they may be even requiring. Okay, you can have the case of inventory, okay, to avoid the stock out cost, okay, okay, the company be having an extra investment towards the inventory. If they need 10 units, they'll be having 13, okay, 3 to cater for the buffer inventory. Okay, so the company will be having an extra investment in either of the account, the receivable, okay, the inventory, okay, towards cash, okay, towards the payable. Don't forget, they want to ensure that they minimize the risk, and the risk here comes in terms of ensuring that the company relationship between itself and the supplier is maintained. Okay, so you do not delay paying the suppliers. If the agreement is you pay the supplier in day 30, you pay them in day 30. Okay, so you imply that for the company investment or the supplier's investment in the company is going to be a bit low. Okay, if you have to compare with the other firms. Now, having said all that, okay, consider the company has a high investment inventory, a high investment in the receivable, a high investment in cash, and a low investment in payable. Then you can see the company has a high working capital need. Okay, don't forget, working capital is simply current assets minus current liability. Okay, so in case the company has high current assets and low current liabilities, then we end up having a case of a company having a high working capital in investment. Okay, to an extent that even some they may not even be need, the company may not need them. Okay, so the company, of course, will be reducing the risk of insolvency. Okay, that's for sure. The company risk of insolvency might be low. However, the company profit-making side is going to be hurt. Don't forget, as you mentioned, the working capital investment make very minimal returns. Okay, they make very minimal profits for the company. Okay, the long-term assets are the one that yield high profits. Okay, but these are current assets, so they yield quite low profits or returns to the company. So you're going to have more of liquidity, but less of profit-making side. Okay, that's on the case of the working capital conservative policy. Then you have the case of the aggressive working capital policy. Okay, the aggressive working capital policy, I think you have, as we have just mentioned. Okay, in the case of the aggressive working capital policy, it is more or less like in quote the opposite of the conservative. Okay, what happened that here they're going to have the managers of the company being more of risk takers. Okay, what implies therefore they will, as much as possible, only have the minimum required inventory balances. Okay, for example. Okay, so if the need for company is 10, they will only be having 10. Okay, they don't include over invest. Okay, however, don't forget the risk is a bit high because in case the demand of the inventory of what you're selling is higher than what you have at hand, of course you end up having a catastrophic cost. Okay, in the case of cash, if the need of company in a day is 1,000, so only have 1,000. That's what company managers will be doing. They'll only be having what is required. Okay, so if the need is 1,000, only have 1,000. If the need is 10,000, then the company will only be keeping what is needed. Okay. When it comes to, for example, the case of the customers, okay, of course, they can be in quote stringent, okay, to their customer. If the terms or conditions that you sell, we sell to you and you're meant to pay in 30 days time, then in day 30, you're going to be on your door, okay, trying to get the deal, okay. So the company will be chasing the customer to ensure that they get paid their money, okay. Of course, you may have cases where you may have bad terms with your customer. So therefore, you may have case of say the company sales decreasing. However, don't forget, since the company is reducing the amount they are investing towards working capital, it means they are investing in long-term assets. Okay, that assumption. Okay, would imply therefore you can have a case where the company therefore is investing more towards long-term as opposed to the short-term. Therefore, an increase in company profitability. However, an increase in the company in solvency risk. Okay, so in the case of aggressive, if you compare the two policies, aggressive and conservative, aggressive, you have more profit, but you have a higher risk of illiquidity, okay, higher risk of being deemed illiquid. Okay, in the case of the conservative policy, is the reverse. Okay, we have a case where the company may end up having a risk of being having low profits, but being more solvent. Okay. And last policy is what we call the moderate policy. Okay, and the moderate policy is more or less in between those two. Okay, it's some element of it to be more towards aggressive, some element of it to be more towards the conservative. For example, towards the customer, the company might be very stringent. Okay, towards supplier, they don't pay them on time. Okay, so you see it's a mix of the two policy. Okay, for the customer, you follow an aggressive policy. For suppliers, you follow a conservative policy. Okay, you don't pay suppliers on time. You take longer than what the other company take to pay their suppliers. So a moderate policy is a mix of the two. So some component of current assets, okay, follow aggressive, others follow conservative. Some component of current liability follow aggressive, others follow conservative policy. Those are three working capital investment policy. Clear?
Yes, it's clear.
Okay, that's good. Okay, because the examiner is going to ask you, discuss three working capital investment policy. But I think that was a question your examiner asked. Let me check from your past paper. If I remember, I think I saw that question. You meant to make a distinction between the three working capital policy. Let me check that question. Let me check it out. Of course, a theory question. But if I remember it, I can't remember it was, but so we can do it. See it. Let me check and see it. This can do. It's able to get it. I think it was a 6 marks question if I do remember well. If you find it, let me know. Yes, here it is. Okay, no, this is on financing policies. Okay, question 1. Okay, that is in May 2018, question 1. Even as explain 3 working capital financing policies and their implication in an organization. Okay, so this was financing. This was not investment. But either way, the question can also be asked, explain 3 working capital investment policies and their implication in an organization. So it can be asked. Okay, and for now, let's discuss on the financing policy. So let's go back. We discuss on the financing policy. Now, when it comes to the financing policies, okay, there are 3 of them actually. Okay, you're going to follow aggressive, conservative, and margin policy or moderate policy. So there are 3 of them. Okay, just like the case of investment policy, they also have 3 financing policies. Okay, aggressive, conservative, and margin policy or a moderate policy. Now, before even discuss on those 3 policies, the first thing is to get to know that when it comes to working capital, we can distinguish the company current assets in 2 classes. Okay, you're going to make a distinction of the company current assets in 2 classes. Okay, we have called the permanent current assets, and we have called the temporal current assets. Okay, I think I have them in the next slide. Okay. So we're going to discuss that in the next slide, okay, that it is possible for us to classify the company current assets in 2 classes, okay, permanent current assets and the temporal or fluctuating current assets of the company. Either way, the 3 policies, the aggressive working capital financing policy, the conservative working capital financing policy, and the moderate or the margin working capital policy, the key distinction is simply on the how is the risk attitude of the managers, okay, as we had mentioned previously. How is the risk attitude of the managers, okay? Now, the financing of working capital can come from 2 main sources, either a long-term capital source, okay, or a short-term capital source, okay? There is a way to cut this, either from short-term loans or from long-term loans, okay? So between the 2, the long-term loans or the short-term finances, which one is more risky?
Long-term.
Long-term loan is more risky. Now, long-term loan is more expensive, but it's less risky. Let's take this perspective. If you take a long-term loan, okay, for 5 years, okay, you go to and agree to the bank that in the next 5 years, the interest to be paying is 10%, okay? Which means, therefore, in year 1, 2021, for example, you pay 10% of the amount you borrowed. The same applies all the way to 2026. So every year, you pay a fixed interest of 10%. If you take a 1-year loan to finance the 5-year capital need, okay, you assume the need for capital you have is for 5 years, okay? So you can either take a 5-year loan, a 5-year loan, or you take 1-year loan, 5 of them. Do you get that concept? Anyway, let me use my board so that I can illustrate my point. So here we have the following case. You want to finance the need for capital capital need is for 5 years. Capital need, that's even 3 years. Capital need is for 3 years. So you either finance, okay, using a 3-year loan where every year you pay 10%, so you pay a fix of 10% every year. Or you take 3 1-year loan. If you're going to have 3 distinct loans, you take a loan, for example, year 2021, another year 2022, and another one in 2023. Assume the interest we pay here is 2021, okay? This will be 2020, so to make it easy, okay? Today, 2020, okay? 2021 and 2022. So today, assume that you agreed with the bank. If you take a long-term loan, you pay 10%, okay, more expensive. In case you take a one-year loan, you pay, for example, 9%, okay, a bit cheaper. However, don't forget, at the end of year 2021, for example, at the end of the year, okay, you need to take another loan to refinance the already maturing loan because you took a one-year loan. So therefore, you need to enter into another distinct loan contract with the bank, okay? Now, how much interest, through the guesswork, how much interest do you pay for the loan you take in the year 2021? It's just guesswork. These are just hypothetical figures I've just picked up. So in the year 2021, the loan you take in the year 2021, how much interest do you pay? Any hypothetical value, that is.
Do you have the amount of the principal?
The principal is the same. The principal, let's just assume that it is $10,000 for each case, $10,000. If you take a 3-year loan, you take only once because you take a 1 year, you take a loan that matures in 3 years' time. But in case you take a 1-year loan, you'll be having 3 distinct loans because every loan matures in year 1. So it's maturing 1 year later, 1 year later. So here, to satisfy the same need of 3 years, you'll be forced to take 3 distinct 1-year loans. You get the concept? Okay, so in the year 2021, how much interest do you pay for the 1-year loan you take in the year 2021?
I think it's still 9.
It should be 9.
Yeah.
It's not a must. Don't forget here it is in future because this loan you'll be taking today. If you borrow from the bank charges you 9%. In the year 2021, is it a guarantee you'll be borrowing at the same 9%?
No, it might reduce or increase.
It might reduce or increase. Assume it reduces to 6%. Okay, 6%, for example. Now, in the year 2022, you take another loan. Well, how much interest do you pay then?
Maybe 7%.
7%. Now, using those figures, now here we took a 1-year loan. Okay, for the 3-year, we took a 1 year where the interest is fixed at 10%. Okay, for those who, I think you should remember your math. What is the standard deviation for the interest rate here? What's the variation of the interest rate from the mean for the interest rate? Hey, you're taking a loan where the interest you pay is 10% fixed. So what is the standard deviation of the 10% interest you pay over those 3 years? What is deviation of the interest rate from the mean? That's what we mean by standard deviation. You guys, you can't be that poor in math. You don't need to do a calculation there, by the way.
Excuse me, sir.
Yes.
I'm not getting the question. Can you please repeat?
What is the standard deviation of the interest you pay on the 3-year loan? You know what is standard deviation? All of you have done this in high school, at least the bare minimum. You have done it in high school, at least the bare minimum.
Is it 2.7?
2.7 for for this loan here.
I think it's just going to be 10%.
Going to be 10%. If you mean,
I mean,
you mean therefore that,
the
sorry?
mean.
The mean,
I was talking about the mean.
Yeah, mean will be 10%. I agree. The mean is 10%. What about the standard deviation? The mean is 10%. That's really true. What about the standard deviation? You guys. Lillian.
Yes, I'm thinking it's 0.
Yeah, it's 0. Thank you. It's 0. That's the deviation here. It's 0. The interest doesn't deviate from the mean. The mean is 10%. The interest is 10%. So the deviation is 0. Hey, you guys. I know math is not a cup of tea, but hey, this is too easy for you not to get it. Anyway, so here, in case we take a 3-year loan, the interest is 0. Now, the standard deviation is a measure of risk, by the way. It's a measure of risk. Now, here the risk is 0. There's no risk more or less. Okay, there's no risk. Okay. In this example, there's no risk. Now here, with the figures here, there's deviation. And you can see here is 9%, here is 6%, here is 10%. What does it mean, by the way, in our, let me call this case A, case B. What does it mean? I hope these figures can are divisible by 3. Similar to be divisible by 3. So
7.3.
7.3. 7.3. Let me use figures that are divisible by 3. So 9. If we say this is 10, let's give us 19. 5%. 24. Yes, that's divisible by 3. You get mean of 8, isn't it?
Yes.
You get a mean of 8%. Okay. You can do calculation, but you don't do that for now. Okay. As you can see, the actual interest rate here, the 9%, is deviating from the mean of 8%. The same applies here. The same applies here. So there is deviation. So there is risk. There is a risk that will be a deviation. Okay. You can do the calculation that in case you want. Okay. So 9 minus the mean, okay, squared plus, which you don't need to do, but anyway, to just state our point, 8, 10 minus 8 squared, 5 minus 8 squared, we divide by 3 minus 1, okay? So you get a figure, okay? But just to state that in the second scenario, okay, there will be risk, okay? The chance that the interest to be charged will not be at the mean of 8%, okay? That's for sure, that's not the case, okay? So then get a square root, okay? That'll get it for standard deviation, okay? So therefore, if we take, the point I was trying to illustrate here is that in case we take a short-term loan, where this is 1 year, okay, if we take a short-term loan, what happens is that you're going to be exposed to an extra risk, okay? They are more risky than the long-term loan. Here we got a 0 standard deviation, okay? So short-term loans are more risky, but they're cheaper. We can just use, for example, this case here we just done here. Here you got 10% as our mean. You got 8%, okay? To illustrate that this is more cheaper, but it's more expensive, but it is riskier. Okay, this is cheaper, but more riskier. This is more expensive, but less risky, okay? So it's a balance between the risk and the interest rate you be paid, okay? Either way, going back to the policies we just mentioned, aggressive, conservative, and the matching policy, okay? So in case a company, you can have managers who are more of risk takers, they finance using the more risky finance source, okay? They'll be financing using the more risky financing or alternative. If you have managers who are more risk averse, they'll be financed using the long-term capital source, okay? They finance using option A, the long-term, as opposed to using the short-term, okay? Clear?
Yes.
Okay. So this was just simply to just say to you that short-term is more risky than long-term. Okay, so that you get to know what distinguishing between the policies. As I mentioned, okay, that when it comes to working capital, we can distinguish the company current assets into two main categories. You can make a distinction with the company. This one you're doing for counting. Okay, IAS 16. Okay, I think we have done that already by now. Now, when it comes to the current assets, okay, we distinguish them into these two distinctions: either current or non-current, either current asset, either permanent current assets or temporal current assets. Okay, so we are called permanent current assets, and you have current. Yes. Permanent working capital. Okay, should have made a distinction better. Let me have the notes here. Here, this is the wrong term to use here. Okay, this is called the permanent current assets. Okay, the term should be permanent current assets or permanent current assets. Okay, so the term should be like this. So this can be a bit confusing. Is a permanent current assets, okay, or permanent working capital. That's what I meant right there. It can be a bit confusing. Okay, so permanent current assets, and you have called permanent, or what referred to as permanent working capital. Now, what makes up therefore the permanent current assets? Okay. Now we make an observation that our period of evaluation, if you're going to make an evaluation for a month, okay, or for a week, okay, during the period of assessment, we determine we are evaluating based on days. Now, among those 6 days in a week that the company was operating, what was the company minimum investment in working capital? What was the company minimum investment in working capital? If, for example, this Monday, Tuesday, Wednesday, Thursday, Friday, Saturday, okay? So on Monday, we required 1,000. Okay, we required here 2,000. We required here, that's 1,500. Required here 3,000. Required here 2,500. Okay, this amount of work is required per day. And here required 700. We determine what was it between that, for that 1 week, what was the company minimum amount that required to invest in working capital? Because you see it was on Saturday, which was 700. Therefore, the 700 become therefore the permanent current assets or the permanent working capital. Okay, it's a minimum investment required over a given time period. Clear? Now, the temporal or the fluctuating current assets, okay, the temporal or the fluctuating current assets is excess over and above that minimum. Okay, the amount extra over and above that minimum for that time period, okay, for that 1 week. If you have to observe other days, within that week, what was the extra investment the company required over that minimum? Okay, now the extra investment the company requires over that minimum is called the temporal or the fluctuating current assets. Okay, so let me just go back to the illustration I just given here. Okay, that you have Monday or the Saturday. The minimum we have said is equal to the 700 you have here. Okay, the 700 here you have here. Okay, so for Monday, for example, what was the extra investment required over that minimum? It is 300 because the minimum is 700. However, on Monday, we requires 1,000. So what's the extra investment for Monday? 300. For Tuesday, okay, I want to assume that this figure was 2,000. So it was 2,000 here. So the extra investment over and above the minimum is equal to 2,000 minus 700 to give us therefore 1,300. Okay. The same applies for all the other days. So the temporal working capital or the temporal current assets is the extra investment the company must make over and above that minimum. Okay. Don't forget the minimum remain, so it does not want to. As you can see, the minimum here was 700. So it is the same for Monday, Tuesday, Wednesday, all the way to Saturday, because that was the minimum. Okay. However, the extra investment required is the temporal current assets. Clear on the distinction?
Kindly repeat the 2 points, the distinction
Between
the permanent and the temporary.
the permanent and the temporal. Okay. So let's just do this example so that makes, I think this becomes a bit easier. Okay, go through this example, then we attend together. So this example, you've been given the days, this is the given week for 5 days, okay, Monday all the way to Friday. So you determine, or you meant to prepare a schedule here that shows the permanent and the temporal current assets of the company. So as I mentioned, the permanent is a minimum investment the company must make over, over that time period, okay. So let me just expand my screen here. Hope it will be better. Okay, it is. So therefore, if you check on Monday, it was for the total working capital required was for 3,000, and the minimum occurred on Friday. And on Friday, it was 8,000. Okay, therefore, 8,000 becomes for the permanent working capital. Okay, the permanent working capital. Can you see my screen?
Yes.
Yes.
Yeah.
It's the schedule. So here I can say this is day 1, let me see, to represent Monday all the way to Friday. Day 3, 4 to day 5. Okay. So day 1, permanent working capital. Okay. So let me just call it permanent. Is the minimum. And the minimum remains the same. Okay. It is a minimum that was over that time period. What was the minimum? It was 8,000. So therefore, it is effective of the day. It is 8,000, the minimum. Therefore, on Monday, 8,000. Tuesday, 8,000. 8,000. Just a minute. So 8,000, Tuesday 8,000, Thursday, Friday. And so the extra investment over and above that minimum is the fluctuating. So here I can call the fluctuating or the temporal. So let me go fluctuating current asset. Fluctuating current asset. Whoop. Okay, fluctuating current assets. On Monday, the total investment was 43,000. So the extra is 40,000 minus 8,000, give us that 500, I guess. That 500. On Tuesday, the extra investment over and above the minimum, 45,000 minus 8,000 to give us that 10,000. On Wednesday, that's 2,000. On Thursday, that's 2,000 also. On Thursday is 44, that's 4,000. And on Friday, 0. That's how you prepare a schedule between the decision between the permanent current assets and the fluctuating current assets. Clear?
Yes.
Okay. That's how you prepare a schedule that shows the permanent and the temporal current assets. Okay. The reason why we need to make this distinction between the permanent current assets, okay, between the temporal and the permanent, okay, is the financing might be different depending on what method you're using. Okay, so the financing might be different. Okay, if, for example, okay, let's discuss now financing policies. So I hope it's clear because I want to go to the next slide. So you see that the 3 policies you can use: aggressive working capital financing policy, conservative working capital financing policy, and you have the matching or the moderate working capital financing policy. Okay, so they're just like investment policy, but these are financing policies, but the terms are the same. Okay, let's begin the first one, aggressive policy. When it comes to aggressive policy, okay, the aggressive policy, as mentioned, don't forget the managers or the people are in charge of working capital financing decisions. Okay, the idea they have when it comes to financing of the company working capital, or they are more of managers who are risk takers. They are aggressive managers. They are more of risk takers. Therefore, they'll be financing the largest proportion of the company current assets using the risky financing alternative, the short-term finance source. Okay, Therefore, the company bulk part of current assets is financed using short-term finance. Okay, and we have mentioned we can distinguish the company current asset in two. We have the temporal and the permanent. Okay, for the case of the permanent, the case of the company current assets, okay, the temporal plus the permanent, they are financed more using the short-term finance source. Okay, why do the company want to do this? The company want to finance this because they're geared towards making of profit as opposed towards the risk of insolvency and the risk of liquidity. So the manager seems to be more of people who are trying to chase for profit as opposed to the company liquidity, the company solvency. Okay, that's in the case of the aggressive working capital policy. The terms, just look at the term. What the term means here? Aggressive. It means they are more of risk takers. Okay. As I mentioned, since we have the repayment, if you remember that's the case I've just given, not cases, but that's an example I've just given you, okay? Where you have a 3-year loan and 3 individual 1-year loan, okay? Don't forget, in case you take 3 individual 1-year loan, then you have to pay. If you took the loan in 2020, you have to plan by the end of year 2020, you need to pay back the money and borrow, okay? You need to pay back the money and you borrow more, okay? Therefore, at the end of year 1, year 2020, you borrow the money in January, in December, you pay the money. So you have to plan that at the end of the year, you need to have money. That's what you have to say. You're trying to say here that you have high risk of liquidity, high liquidity risk here. Okay, because the repayment is more frequent every end of the year compared to a 3-year loan. Because in case you take a 3-year loan, you borrow the money in January 2020, you pay it at the end of year 2022. You pay at the end of year 2022 or beginning of year 2023. So therefore, you're paying on the ones, okay, for those 3-year period. If you take a long-term loan, but in case you take a short-term loan, you're paying every year. That's why the risk is a bit high. Okay, hope that's clear. Okay, that's for the aggressive working capital financing. Okay. Okay, the implication of it I've already mentioned. There's increased profit because don't forget, short-term finance is cheaper. Okay, therefore you pay less interest. Okay, you pay less interest, therefore you're going to have a case where the company profits are a bit high. However, the risk is high. Okay, the risk is high. The profit you're making is high. Why? Because the interest you pay is low. Interest on short-term loans is going to be lower than on the long-term finances. Okay, however, the risk is high. Okay. So here I mean long-term finance, this short-term borrowing. Question? Okay, so the question. In the case of the conservative working capital financing policy, it's just like in quote the opposite of the aggressive working capital policy, where now the company will be financing most of the company working capital need using the less risky financing alternative. In this case, they will finance using the long-term finance source. Okay, so the company, most of the company working capital needs again being financed using the less risky finance alternative. In this case, the long-term finance source. Okay. Having said that, now what does that mean? Therefore, is that don't forget the long-term finance source is a bit more expensive. It's less risky, but more expensive. Okay, which means therefore you're going to have less profit because you're paying high interest rates. You're paying high interest due to the high interest rate of long-term capital source. However, the company has less liquidity risk because, as I mentioned, the frequency of paying the principal is shorter. Because if you take the loan in 2020, you'll be paying it at the end of year 2022 or beginning of year 2023. Okay. However, if you are to take a short-term loan, you'll be paying every year. Therefore, you have more risk of liquidity. Okay. So it's simply balancing which of the objective is this company seem to be pursuing more. Is it liquidity or more profit? Okay, that's what the finance is done. Now, the implication, as we have mentioned, is that there'll be an increase in the company chance the government might not make high profits because you're paying high interest rate to the bank. However, you have lower risk of illiquidity. Okay, you have lower risk of illiquidity. Okay. That's for the case of the conservative policy. Question? The last financing policy is the matching policy. And in the case of the matching policy, it's a mix of the two policies, okay? Just like the way we saw under the innovation policy, under the financing policy, the matching or the moderate financing policy, we can be using a mix of those two, okay? A case where we have the company using both long-term and short-term. So essentially what happens is that the company, the financing, the company working capital need the permanent current assets, okay, using long-term finance source. Okay, the permanent using the long-term financials. The fluctuating or the temporal current assets, the fluctuating or the temporal current asset company we finance using the short-term finance source. Because we see it's going to be a mix of the two financing, both short-term and the long-term. Okay, which of course it implies therefore that the cost of the company is going to be in between those two. Okay, if you to compare company finance using aggressive, the company finance using conservative, the company using matching policy will be in between the financing cost of those two companies. Okay, both using a mix of both short-term and the long-term finance to finance the company working capital needs. Clear?
Yes.
Okay, now let's do an example. If it is clear, I guess we can do an example. Okay. So let's take an example from your past paper. The question examiner asked you to prepare. Let me check. It should be a recent question. Give me a second. If we check November 2019, November 2019, question 1. Where is this? Yes, question 2B. November 2019, question 2B. Okay, go through it in the next 1 minute or so, then we attempt it together. Okay, I presuppose you have gone through the question. You have identified what the examiner requires of you from this sitting. So you're meant to prepare a schedule for the permanent or the permanent and the fluctuating or the season working capital. Get the cost if you have to use aggressive policy, conservative policy, or a matching policy. And of course, we advise the management as which of the policy might be good for them. Okay. So allow me to use my Excel as you also prepare from your side. Okay, just prepare it from your side. So let me just do it on my board here. So you want to prepare a schedule. Here you can have here to be month. There's no format, by the way. You can prepare either horizontally, vertically, whatever you prefer. So month, let me just have 1 to be January. So 2, 3, all the way to the month of December. And can have here total working capital. Total, this column to be total working capital. I can have here permanent current assets. You can have fluctuating or the seasonal current assets, fluctuating current assets. Okay, so month 1, okay, I have to go back to, no, I don't have to. Okay. So month 1, okay, the total working capital, that 5,000. So month 1, that 5,000. Month 2, that is February, 35,000 also. Month 3, 52,500. So 52,500. December, 52,500. Don't get, you need to fill up all the other. So 52,500 for December. Then looking at all those months, the minimum investment in working capital seems to be January and February, which is that 5,000. Okay, that 5,000. So permanent here, that 5,000. That's the minimum. That 5,000 all throughout. That 5,000 all through that 5,000 all the way to the month of December, which is at 5,000. Fluctuating is extra. Therefore, January you have 0, February 0. Month of March, the extra, we simply subtracting, we get 17,500. The same applies for all the other months, all the way to the month of December, 17,500. Then you can get the total. Okay, total for each of the month. Okay, so fill it up. So do for the first month all the way to the month of December. Let me know once you're done. Okay, let me know once you're done. Permanent you get?
For 20,000.
For 20,000.
Fluctuating is 855,000.
855,000. That way.
Yes.
Okay, so we have the permanent. Someone to collect the answer. Collect that answer.
It's correct.
Okay.
Correct.
Okay, thank you. So that's gonna for the company, the schedule, okay, where we want to show both the permanent and the fluctuating current assets. Okay. Okay. Next, we in part B of the question, we are being asked to get the cost of financing if we use aggressive, okay, and the financing cost in case we have to use the conservative. Okay, so the cost in case you use aggressive, cost in case you use conservative, and in case you have to use the matching policy. Okay, so let's go back to our schedule. Okay, so let's use aggressive policy. So aggressive policy, you see that the aggressive policy, you're going to use the short-term finance, you're going to use the short-term finance source to finance the company working capital need. Okay, so therefore, we shall use therefore the short-term finance, and the cost of short-term finance. Let me go back to the question. The cost of short-term finance should be told it is 20%. If you finance it long term, you get charged 25%. Okay, so aggressive we use short-term finance. Okay, where the cost is 20%. Therefore, the interest cost be 20%. Actually, you should have done here the total. So what is the total here, by the way? The total. So total working capital required. So the total should have been here. For 20 plus 855. Confirm. Total working capital.
Yeah, it's correct.
So you get 1,275,000. Okay. So you're going to finance the entire need using the short-term finance. So therefore 12. Here it is. So 1275, you're going to finance using short-term finance source. The aggressive, be using the more risky but the cheaper financing alternative. Don't forget, do you require this 1.2 million from January to December? Do you require this 1.2 million in month of, for the month of January? The question is, if you have to go to the bank to borrow this money, okay, so that you can finance your working capital, in the month of January, how much do you need? How much do you borrow from the bank?
35,000.
5,000. Then the month of February, you top up another 5,000. Only until the month of December, where the total amount you will have borrowed from the bank is equal to 1.275 million. Okay, which means therefore you don't require this money from January. Okay, is an inclination. Okay, adding on top or adding on top. Therefore, you divide by 2 because you don't require this money from January. January require the 5,000. Then you borrow more, okay, all the way until the end of the year. That's how you get, therefore, the average by dividing by 2. Is that clear?
No, it's not.
Okay, let me simply, like the graph we drew for the inventory, okay? Now here, you're going to have here the quantity of cash you require, or the loans you're taking. This is time. This is January all the way to the month of December. In the month of January, you require that 5,000. So borrow that 5,000. Month of February, we add that 5,000. Month of March, you add that 52,000. All the until the month of December, where the cash balance will be like that. Okay, just like say a thing. Okay, that will be like. So therefore, you don't require this 12. This at the end of the month of December, the total amount you have borrowed is 2.75 million. Is that clear?
Yes, it's clear up to there.
Okay. So therefore, it's like this is a histogram we have. Okay, which therefore means that this is the amount that we require. Okay, if you have to draw a straight line. Okay, therefore you have to begin from 0. Okay, it begins from 0. Okay, more or less. Let me just begin from 0. From 0 going all the way until the month of December. Okay, now what's the average cash? Don't forget, you don't require the entire 1.25 million from January. Okay, if the first day requires 0, then it becomes incremental. What's the average here? Is 12.25 divided by 2. If you remember the case of inventory that we did, it was like this for inventory. So it was 10,000, for example, for inventory plus 0 divided by 2. This is now the reverse of it. 0 all the way to 12.5. You divide by 2.
Okay, my question is why we, for the average, why are we dividing by 2 instead of like we have 12 months, so we divide by 12? Like
Because if you look at the graph, it is incremental. In the month of January, we bought the 5,000. Then we adding up, adding on top. Yes. So you don't want to do monthly, but you want to do yearly.
Oh. So if we divide by 12, it's like we are doing it monthly.
Yes, you do it monthly, then if you have to divide by 12.
Okay.
All that's clear, because in case you miss that point, then you're going to end up with the wrong interest rates, the wrong interest cost of the company. Okay, don't forget this is how it is appearing like. So you divide by 2, because if you don't divide by 2, you are assuming you borrowed 1.2 million from January all the way to December, which is not the case. You're borrowing in bit by pieces. Okay, and assume that you're going to be paying the money at the end of the year. The interest you pay at the end of the year. That's the assumption we are having here actually. Is that clear?
Yes, it's clear now.
Okay, now. And again, for the interest, how much the interest do you pay there for?
127,500.
127. It's a minute. I had to meet some people. You get 207. 500.
Yes.
500. Then in case the company was to use the conservative policy, okay, don't forget you're going to finance using less risky finance alternative, but the more expensive, the long term. You pay an interest of 25%, the same amount, you divide by 2. Therefore, how much interest do you pay? Okay, here you're financing using the less risky but more expensive finance alternative, the long-term capital source. The interest you pay is how much therefore?
159,375.
159,375. It's their shillings, sorry. Let's get shillings, not dollars. Then in case you to use the matching policy, if you were to use the matching policy, Okay, if you were to use, the matching policy, no, guys, it will be a mix of the two. Okay, both short-term and long-term. In the case of the short-term, in the case of the permanent, we finance using long-term. Now the permanent, going back to the permanent we got for 20, we got for 20,000. Okay, we also get an average. We finance using long-term, 25%. In the case of the seasonal, let me just go back to the schedule. For the seasonal, we got 855,000. Now we finance using short-term. Okay, so 855,000 average divided by 2. We finance using short-term now, so times 20%. Because as I mentioned, it's a mix of the two. And you get how much? The cost to be in between 1,500 and 159,375. Because it's in a mix of those two, so therefore even the cost will be in between those two. And you get?
Excuse me, sir.
Yes.
I'm not sure I understand what you've done at first, where you did the 420,000 over 2.
Now here, you've said that when it comes to financing, when it comes to the matching policy, you're going to use a mix, you're going to be using both the short term and the long term. For the permanent, which is the for 20,000 here, we finance using the long term. For the fluctuating or the seasonal, you finance using the short term. Is that clear?
Oh, okay, yes.
Yes, then your cost you have to divide by 2 to get the average. Don't forget the matching policy, we are going to use both the short term and the long term. Clear?
Clear.
Okay. So the cost. $130? I'm guessing, I'm not sure.
138,000.
Exactly.
Yes.
Okay, we get 138,000 to be the company financing cost if they were to use the matching policy. If the company was to use the matching policy. Okay. Clear?
Yes.
Question? Okay, no question. Then the last part of the last question is asking us to determine, or you advise the company on which of the policy they should be using. Essentially, the advice here is going to be a bit tricky, because each of the policies will have its own drawbacks. Okay, if you have to use aggressive policy, it has its own liquidity risk. Okay, if you have to finance using the conservative policy, okay, it has its own lower profits returns. Okay. So margin policy, don't forget, at the end of the day, if it looks purely from the cost perspective, then conservative policy is better. However, don't forget, in the case of the margin policy, it is going to have an average of the cost. Okay, you're going to minimize liquidity risk, and you're going to at least try to achieve a higher profit level. Okay, so generally, maybe the margin policy might be better. Okay, but in terms of costing, it is not better. Don't forget. Okay. However, because it is able to balance between the profit and liquidity, okay, it is attempting, okay, to achieve a balance of those two working cap objective, that it might be the better financing alternative, the use of the matching policy. Clear? Question? Okay, so then since there's no question, then some sort of question here. Yes, Immaculate.
Could you please repeat the advice? Because I'm not understanding. Like in this scenario, what advice do we give?
Now, the advice I'm going to give is that the company should use the matching policy. Why? Because of the matching policy, the two objective of working capital are paid attention to. Because in terms of profit making, the company is able to make profit, okay, and not more than what they could have made in case of to use the aggressive policy. Because the aggressive policy, we're using a cheaper finance alternative. However, the profits are better than the conservative policy. okay, the profitability of the conservative policy. However, don't forget for the aggressive, the risk of liquidity is higher, which in the case of the margin policy, that risk has been reduced because you're using a mix of the two. Okay, we are not purely using the short-term finance. Okay, when it comes to the conservative policy, it is better in terms of management of liquidity risk, but it's not good in terms of profit. So the reason is that why we say that the margin policy might be better is that it is able to strike a balance between the two working capital objectives. We pay attention to the company profit side, and at the same time we pay attention to the company liquidity side. The aggressive policy might not be better because of the risk of liquidity. The conservative policy might not be better because of the low profits the company is making. So the margin policy tries to strike a balance between those two limitations. Okay, we make some profit, at the same time we're able to minimize the company risk of liquidity. Clear, Margaret?
Yes, thank you.
And let's mark the head of working capital management. As you can see, it's one of the biggest topic that we shall be discussing. That's marks the head of working capital management. Question on working capital. Don't forget, by the way, I think as we had agreed, we shall have our cut one next week. Okay, next week I think we agreed on first. So first was on it was on second. Yes, we agreed on 2nd of September. We shall have our cut one. So prepare well for the cut on Wednesday. It covers all until what you've done just right now. Sharon.
Okay, I think I'm a little bit confused with the policies. Will you mind a personal recap on the investment policies?
The investment policies, you see that there are 3 of them: aggressive working capital investment policy, conservative working capital investment policy, and you have what we call the moderate working capital investment policy. The key distinction between those policies, as mentioned, we go back to the risk attitude of the managers. Okay, when it comes to the aggressive, okay, managers are more of risk takers. So they're going to therefore have the only required investment towards inventory. So in case they require 10 units of raw material, they only purchase the 10 units. They don't purchase more than what they need. Okay, when it comes to the receivable, they're going to be strict with their customer. Therefore, if the agreement is a customer are meant to pay in day 30, they will ensure they enforce that. Okay. Of course, this is going to have an implication that the company investment in working capital is low. The company has low investment in working capital. Therefore, this will be boosting the company profit. However, be careful, because when it comes to this, if you look at the case of the inventory, if the company only keep what they need, okay, what if the demand is going to be more than what they were expecting? What if the supplier will be delaying, okay, upon making the reorder, okay? So there's a risk here, or a risk of system breakdown, okay? So that's the case of the aggressive policy. In the case of the conservative policy, the managers are more of risk averse in quote, okay? Therefore, they will try as much as possible to avoid cases where there could be system breakdown, okay? So when it comes to selling to the customer, they'll be a bit friendly to the customer. So they give customer better terms, okay? When it comes to the inventory, they have an extra investment towards the inventory. They want to avoid the risk of stockouts, okay? When it comes to cash, they want to keep more cash than what they need. They don't have a case where the company will become insolvent because the need for cash is more than what the company planned for, okay? Therefore, the company working capital investment might be excessive, okay, more than what the company needs, okay? That's for the case of the aggressive, the case of the conservative working capital policy, okay? When it comes to the moderate policy or the margin policy, don't forget to be a mix of in between. In some areas, the company will be having an aggressive policy. Some other areas, the company will be having a conservative policy. For example, the company, when it comes to the inventory, they may be only be keeping what they need. So they follow an aggressive policy. When it comes to the customer, they may be giving the customer better terms than the competitor. So therefore, in that case, therefore, they'll be following a conservative policy. So some element of both the aggressive and the conservative shall come into play. Clear, Sharon?
Yes, it's clear now. Thank you.
Okay, fair enough. So that's on the working capital investment. Working capital investment of particular attention you need to pay is, of course, towards receivable. Receivable is more or less where there is been concern. There could be concern. Okay, more towards the receivable side of it. Okay, and of course some element of cash. Okay, and of course the forecast. Okay, out of cash the company working capital needs. Okay, if there's no question, then I guess we can go to the next topic. The next topic we can discuss on risk and return. Discuss on risk and return. So we can take a short break before we begin this new topic. Joseph, I'm sure Joseph is in class. Joseph is not in class or what? Okay, not in class. Okay, Sharon, we take a break for how long?
10 minutes is fine.
10 minutes.
Yeah.
Okay, so right now it's 7:12, so we can meet at 7:22. Okay, 10 minutes, then we begin with this new topic.
Okay.
Okay, welcome back. So we want to discuss on how to manage, rather, discuss on risk and return. So risk and return. So minute. Sorry for that. Okay, risk and return. Now, what is risk? Essentially, risk is the variation of the variability of the returns over a given time period, or how volatile are the returns of a particular asset over a given time period. Okay, that's what referred to as risk. Okay, it's simply the volatility of return over a given time period, the fluctuation. Okay, let me use that term. How what's the fluctuations of the return over a given time period? Okay, and the return is the return of the expected cash flow from that particular asset. Okay, if you are going to be an equity investor, what return do you anticipate? What cash flows, what receipts, okay, are you anticipating to receive over that time period? If we mentioned this in the case of the equity share, okay, where you say that the return to the equity shareholder is given as the dividend you'll be receiving plus any capital gains that you'll be receiving. So simply, therefore, it will be the capital gains to be received plus the dividend. Okay, that's something that I think you've already discussed together. Okay. The returns are the expected profits or change in the value of an asset or cash flow earned from an asset over a time period. Okay, so if you're going to be an equity shareholder, therefore the return you'll be receiving is the return you'll be receiving are the dividends and the capital gains that the equity share are making for the holder of that equity share. Okay, and just to remind you, if you remember, you said in case of an equity share, the return to the equity shareholder, okay, will be equal to P1 minus P0, which I think we did this. Okay, this is give us a capital gain plus the dividend. Okay, where this is the capital gain, the increase in the value of the share. This is the dividend. And this is what referred to as the absolute return measure. But conventionally, we don't use absolute measure, we use the relative measure, the percentages, okay? Where it is P1 minus P0. We did this already, so nothing new here. Divide by D, we do a P0, we divide by P0, and of course we express this as a percent, okay? We express this as a percentage, okay? Give therefore the total return to the shareholder. Already done this, okay? So nothing much to pay attention to here, okay? Now, of the key concern is the risk, okay? Because my big return is quite straightforward. The key concern is more towards the risk, okay? And you see that the risk is the variability of the asset return from the return that is expected. Is how volatile is a measure of return volatility, okay? If when you see the term return volatility, it still means the risk of the particular asset, okay? So how volatile the return of that particular asset. If we have high volatility, that thing, okay, just to do a simple graph, which I think we need actually under cash management, okay? If what happened here? Okay, it is. Okay, if we have this graph, okay, and these are the returns, and you have another scenario here where these are the returns. Of course, in scenario A, the returns are more volatile compared to the case of B. The risk here is higher compared to the scenario B. Okay, I think we already discussed that. The return concept, we have done this already, so obviously remember all this. Okay, the return is going to be equal to, of course, capital gain plus the dividend. We divide by P naught. Of course, as I mentioned, generally when it comes to assessing the return of an asset, we are going to be using the conventional way, okay, is through the use of the relative return measure. But of course, you have to pay attention to what the examiner is telling you, okay. Then you can have cases where we have what we call probability distribution, okay. The concern is going to be case of probability distribution, okay. Probability distribution, okay, where the return is going to be volatile, okay. They can move up and down, okay. And the outcome or the potential return you'll be receiving are pegged on a probability. So, for example, you can get 10% return. However, the chance of you getting 10% is only 0.3. Okay, then in truth they can get X return, but the chance of you getting the X return is a Y plus Y probability. Okay, so in that scenario, therefore, how do we get the mean return of that particular asset? Okay, the mean return of that particular security. It seems going to be giving us the outcome. In this case, therefore, the return you'll be getting. Okay, therefore, the mean return will be equal to the outcome X we multiply by the probability of X happening. Okay, and since there are many of them, the sum. Simple as that. Okay, this is a sum sign, the summation sign. It will be equal to X. Where is this? It will be equal X times the probability of X happening. Okay, we add the sum for all the event occurring. Okay, simple and straightforward. And that's what we get for the mean return in case of probability distribution. Okay, X we multiply by the probability of X, event X happening, okay, from the first set of outcome all the way to the end set of outcome. Okay, that's what we get there for the mean return. Clear? Okay, a simple example. So go through this, then we can do it together. Actually, first do it. Let me see how far you can go. We're going to get the return for this particular security. So take 2 minutes. Someone is saying my screen is not clear. Can you all see my screen? Bet, can you see my screen?
Yes,
On my
can see
end, I
it,
can
but
see
it's
it.
coming up. And
It is. Okay, okay.
yeah.